Well. We were talking about some of the stocks doing well from the broader markets. Escorts Kubota, on the other side, has seen some sell-off, so at the low point of trade. IRCTC reports its numbers today, is also seeing some bit of a sell-off. And VIP, which has been quite an underperformer, rank underperformer, has continued to see some traction, by and large, in a range, but keeps seeing these sporadic moves every once in a while. This month, it's up 16%. But remember, from the highs, it's seen a big cut as well. But stock on our radar is Gateway Distriparks. Reported a soft set of fourth quarter numbers. The bottom line was impacted by an exceptional loss of over 250 crores. But the consolidated results were actually supported by, the consolidation of Snowman itself. Let's talk about their main organic business, which is that of inland container depots as well as container freight stations. Samvid Gupta, who's the joint MD at the company, joins in now. Thanks a lot, Samvid, for joining in. Let's start with the targets that you have set for yourself for this year. Rail volume for FY25 was down 2%. CFS was just about flat. For FY26, what is it that the street should anticipate? And EBITDA per unit, if you could give us a sense.
Hi, good afternoon. Thanks for having me on the show. So we are looking at double-digit growth on the rail side. The CFS side will probably see some minor growth of about 2 to 3%. But all this depends on long-term, factors like geopolitical situation, also the tariff situation, which we'll get clarity in July. But there are some positives like the FTA is being signed by India and UK. India and EU also in discussion. India-US trade deal, whatever ends up happening, there should be a realignment in global trade in favor of India. So we're positive on the long term, but double-digit growth is still on our minds overall.
And what about EBITDA per unit?
EBITDA per TU on the rail side, we're looking at about 9,500. Hopefully, we can push that to over 10,000 per TU after the JNPT leg gets connected on the DFC. And on the CFS side, it'll be about 1,500 per TU.
All right. And, what is the kind of double stacking that you managed to achieve in FY25? And what would be your target going into FY26?
So our average was 40% for the year. And this was basically dragged down in Q1 when the whole Red Sea crisis was going on. So Q1 was at about 33%, but we've managed to consistently do over 40% in Q2, 3, 4. So our target for next year is about 45% on double stacking.
All right, double stacking 45%, 40% is what you've done. You spoke about the impact that, the JNPT being connected to the Western Dedicated Freight Corridor comes by. There were reports that suggested that it actually is, the opening is likely to be brought forward from December to October. Have you heard something on that? And if that were to happen, what could that do to your volumes and market share?
So it really depends. I mean, 2-3 months here there won't make a large difference, but basically this will be an alignment of trade again, shifting from other ports to back to JNPT over a period of say 1 or 2 years. So we don't expect any immediate ramp up like that, but over time we think we would benefit as it's longer distance. So longer lead distance would mean better revenue and margin for us. As well as where we have a pan-India license, and not all rail operators have a pan-India license. So we'll be one of the fewer operators out of JNPT.
Sure. And how many terminals and ICDs have come on stream in FY25 for you, and how many more are likely in FY26 then?
So we have 5 ICDs and 5 CFSs. We don't have any new ones opening up this year. We have plans for 2 new locations, but land acquisition has been a challenge, so we've not been able to finalize yet. Whenever we do finalize, it'll take 2 years minimum for those to operationalize. Meanwhile, what we've started looking at is some asset-light options where we operate out of third-party terminals or third-party sidings, which we weren't doing in the past, and some domestic movement as well. So hopefully 1 or 2 of those locations should come in within this FY.
So what should that do to your total overall handling capacity? That's point number 1. And secondly, what does that do to your market share? I mean, I briefly did ask you about that because, a week ago we got Container Corp. They said that they've maintained their market share, whereas everyone else is claiming that they've gained market share, which is the other players. So have you gained market share? Is it at the expense of Container Corp? Or what is really happening in the market?
So our NCR market share has gone up from say about 16%, close to almost 17.5 to 18%. It's not specifically come from one operator, it's come from all across. Ludhiana, we went down to 21%, but this year we've gone back up to 27, 28%. Again, it's from multiple operators that we're doing. We don't measure on a like-to-like basis with Concor our market share since they operate out of a lot of more locations. So we only focus on the regions where we're operating in. So these asset-light locations again would be new geographical locations for us. So that would increase our pan-India market share, but not again at the expense of anyone else.
So, in the regions that you operate with Container Corp, where does your market share stack up against? How does that stack up against them, and how has that moved?
So NCR, we've gone from 16 to 18%.
That's
Concor, I'd say, still dominating the NCR market share with over 50%, and they've been stable at that figure. Ludhiana, like I was saying, 21 to 28% we went, and all the operators would have lost some market share while we did that. And Uttarakhand, we've gone up to almost 37% in this last quarter, which we were at about 28% the year before. But overall, markets of Ludhiana and Uttarakhand have actually degrown. So that's also playing a factor in why our volumes are not rising up as much as our market share.
Sure. And what happens to your profitability when you have, an asset-light approach when it comes to your additions, and what does that also do to your return ratios?
So there's no capex involved in those sites, and the rakes are also on lease basis. So that way the ROCE would improve. But the EBITDA per TU would be lower as we're not going to get any handling income or any first last mile income. But it would still be to the order of about 25% margin that we'd be operating at.
and with the freight rates the way they are, with your increased volume targets, etc., what's the kind of revenue growth that you're penciling in for FY26?
Again, like I was saying, it depends on the geopolitical situation and the tariff situation, but we are looking at least a 10% growth, and this is not counting the Snowman consolidation coming in.
You gave us a nice setup with the Snowman thing there. Over the last 1 year or so, 45% has gone up to 50%. Last 2 years, 40% has gone to 50.1%. Where do you take it from here? Do you intend to take it beyond 51% or just hold it steady for now?
So we're not against the idea of increasing our stake. We basically first will take care of Gateway's capex plans and the dividend that we pay out regularly. And if there's a free cash flow situation, then we could look at increasing our stake. But again, no immediate plans on it.
That's not priority. After having raised it with so much, you don't intend to rush into buying more of Snowman, right?
Actually, yes.
All right. Thank you so much for joining in and giving us all those updates. With that, we'll simply do a short break, get you more on the markets and a lot of stock-specific action. Stay with us.